actions, including today's 75 basis point cut. I'm joined now by Scott Anderson. He's a senior economist at Wells Fargo in Minneapolis, and Peter Schiff, the president of Euro-Pacific Capital. Gentlemen, I welcome you both. And Peter, I'm going directly to you because clearly when you see a 420-point gain in the Dow, it's pretty obvious what investors are saying. Thumbs up. Thank you, Ben Bernanke. You don't think the Fed's on the right track. Why?
Well, not at all. First of all, we're in a bear market, and when you're in a bear market, you get pretty spectacular rallies. We've had a lot of these big rallies, and then, within a few weeks, we're back at new lows again. But, the Fed is creating inflation. It's not fighting inflation. The Fed sees inflation as the way to solve these problems. It wants to inflate our way out of the problems, but that's how we got into this mess. The Fed did the same thing in reaction to the bursting of the NASDAQ bubble that it blew up. It blew up the housing bubble to postpone the pain of that recession. It created all these problems. The solution is not more debt. It's not to encourage Americans to go out and buy more things that they can't afford. What we need is more savings in this country, more production. We need sound money, and we need much higher interest rates. And if that means in the short run we suffer a severe recession, that's what's going to happen. Because what they're doing now is going to be much worse down the line as a result of what Ben Bernanke is doing.
So, Scott Anderson, tough love. That's what Peter Schiff says we need. And again, we all know that if you try to avoid painful situations in life, you often do just make it worse in the long run. What's wrong with what Peter is saying?
Well, Bernanke is a student of the Great Depression and financial panics and crises, and what we learned from those past crises is that the Fed needs to be as accommodative as possible to unstick the credit markets and get the banks lending again. The best way to do that is for the Fed to continue to cut rates to make it more profitable for banks to start lending again and offset some of the concerns the banks have about rising defaults and foreclosures. So, holding the line on interest rates would be absolutely the wrong thing for the Fed to do at this point.
Yeah. Unfortunately, maybe Ben Bernanke studied history and studied the Depression, but he learned nothing from it. What he should do is look at the history of Argentina. Look at what's happening in Zimbabwe right now, because those are the type of monetary policies that he's pursuing. And we have something far worse in our future if we do not veer from this course.
Well, I agree that
Go ahead. You just dive right in.
Yeah. Well, I agree that the Fed needs to be seen less of reacting to the markets. They need to show some leadership, some backbone. And that's why I think the markets applauded what the Fed did today. The Fed didn't give the market exactly what they were looking for. Instead, they gave a little bit less than that, subtly reasserting themselves in the marketplace that, we're going to use other methods, not just our blunt instrument of Fed rate cuts that potentially are inflationary down the road, but we're also going to use our temporary auction facility and our new lending facilities to get at more directly at some of the problems.
All they did is get everybody to expect a 100 basis point rate hike, so now they can cut by 75 basis points and pretend they're hawkish. This is ridiculous. The dollar is going to continue to fall. They are creating inflation, and again, this is the problem. Our economy, we're not suffering from a lack of consumer spending. We have too much consumer spending. We need savings. In order to encourage savings, you need high real interest rates.
But Peter, isn't that a long-term
concern?
Isn't that a long-term concern? We've seen retail sales slow down, and in fact, we were showing a chart while you were speaking, showing the year-over-year consumer price inflation rate, which has gradually come down. The last consumer price report showed the monthly CPI flat.
Yeah.
Well,
first of all, the CPI it doesn't represent what's really going on with prices. That's the government's version. Inflation is causing prices to rise.
Let's take it as the version that we're good as our yardstick, regardless of whether you believe it or not.
I'm not going to use a flawed method of measuring prices, but we don't need more consumer spending. We need a lot less consumer spending. The problem is we've borrowed all this money from abroad. We owe the world trillions of dollars. We didn't borrow to invest. We didn't borrow to build factories. We borrowed to consume. And now we can't pay it back. The dollar is in free fall. We need to radically change the way we've been running our economy. We need to produce things again. We need smaller, less expensive government. We need sound money. We can't just keep encouraging reckless borrowing, because that's how we got into this mess.
Okay.
And we're not going to solve the problems of inflation by creating additional inflation.
Scott, when you see gold over $1,000 an ounce, it does make you kind of nervous, doesn't it?
Well, that's true. This isn't really consistent with a deflationary spiral. But I'd point out in 1991, we also were seeing accelerating inflation when we went into recession. But as growth slowed, we did see a moderation in inflation. And the Fed has actually historically been pretty good forecaster of inflation. So I'd go with the Fed's forecast on inflation, that this is demand-driven, and as the economy slows, we're going to see some moderation there.
No, I'd go with gold. I wouldn't trust the government. You know, I've been buying gold, and I've been encouraging my clients to invest in gold and foreign assets and commodities for about 8 years because I understood how much inflation the government was creating. You know, the government doesn't want people to understand how much inflation they're creating, so they hope that you'll buy into these phony measures that they put out.
You seem to be totally sidestepping a big issue, and Scott, maybe you should address this, which is the housing market. Home prices are still falling. We got another big drop in single-family home construction today. Foreclosures are rising, and this seems to be the linchpin that is crumbling against the economy. Scott, isn't that the thing that the Fed is addressing or trying to?
Yeah, we're very much focused on that, as is the Fed, and we've already dropped in terms of national home prices more than we ever dropped since the Great Depression. So our models around this aren't very good, but we certainly know the direction that things are headed. Yeah. We're seeing a lot of wealth destruction from housing and the stock market since the beginning of the year, and that's going to weigh on consumer spending, and the Fed needs to react to that.
But home prices are going to fall a lot more. You know, this was all phony wealth. It was a bubble that the Fed inflated, and prices are going to come down across the board. But, you know, the cost of home ownership, even though home prices are falling, the cost of buying a home with higher down payments, higher mortgage payments, higher taxes, higher maintenance, higher depreciation, home ownership costs are going up, along with the cost of food, along with the cost of energy.
Okay. Peter Schiff, thank you. You've certainly eloquently made the case for the rising inflation. And Scott Anderson.